Imagine waking up one morning and finding out that the silver price you see every day is not really set by supply and demand, not by miners, not by investors, not even by people who actually own silver bars, but by paper contracts traded behind closed doors. What if the real silver market is completely different from the one shown on your screen? And what if only a few powerful institutions truly control it? Today, we're pulling back the curtain on COMEX, LBMA, and physical silver to answer one big question. Who actually controls the silver market? If you've ever wondered why silver feels undervalued, why prices crash in seconds, or why physical silver sometimes disappears when demand explodes, this video is for you. And trust me, by the end of this, you'll never look at silver prices the same way again. Before we go deeper, make sure you hit the like button and subscribe to the channel. It really helps Empire Economics reach more people who want to understand how the real financial world works, not just the versions shown on mainstream charts. If you enjoy deep dives like this, you're in the right place. Now, let's start with something simple. Silver is not just a shiny metal. It's money. It's an industrial metal. It's used in solar panels, electronics, medical devices, and military technology. Unlike gold, silver gets consumed. Once it's used, a lot of it is gone forever. That alone should make silver extremely valuable. Yet, for decades, silver prices have stayed surprisingly low compared to gold. That's where COMEX and LBMA enter the story. COMEX stands for the Commodity Exchange, based in the United States. On paper, it's a futures market where buyers and sellers trade silver contracts. These contracts are supposed to represent silver that can be delivered in the future. Sounds fair, right? But here's the catch. Most of the silver traded on COMEX does not actually exist in physical form for delivery. It's paper silver. In fact, for every single ounce of physical silver in COMEX vaults, there can be hundreds of ounces traded on paper. Let that sink in. Hundreds of claims on the same ounce of silver. This means price discovery is happening in a paper market, not a physical one. Prices move based on contracts, not bars. Now, you might ask, why does this matter? It matters because paper silver is unlimited. Banks can create contracts out of thin air. Physical silver, on the other hand, is limited by mining, refining, and real-world supply. When paper silver dominates price discovery, it suppresses prices, and this benefits a very specific group. Large bullion banks and financial institutions are the primary players on COMEX. They trade massive volumes using algorithms and high-frequency trading. When silver starts to rise too fast, huge sell orders appear out of nowhere. Prices smash down in seconds. This isn't normal market behavior. This is control. Many analysts call this price management. Not officially, of course, but when you see silver drop $1 in minutes without any major news, you start asking questions. Physical silver doesn't vanish in seconds. Only paper does. Now, let's move across the ocean to London, where LBMA operates. LBMA stands for London Bullion Market Association. This is where the global spot price of silver is heavily influenced. Unlike COMEX, LBMA is an over-the-counter market. That means trades happen privately between big players, not on a transparent exchange. LBMA deals mostly in unallocated silver. That's another key word you need to understand. Unallocated silver means you don't own specific bars. You just have a claim. The silver may not even exist. You're trusting the system. Just like COMEX, LBMA operates on leverage, massive leverage, multiple claims on the same silver. And just like COMEX, this system works perfectly fine until people start asking for physical delivery. History shows us something very interesting. Whenever demand for physical silver spikes, the system starts to shake. Premiums rise, delays appear, mints run out of supply. Dealers put up out-of-stock signs. But the paper price stays calm or even drops. That disconnect tells you everything. Think about 2020, global shutdowns. Supply chains broken, investment demand exploding, people buying silver coins and bars like never before. Physical silver was disappearing, yet paper prices struggled to reflect that reality. Why? Because the price wasn't being set by physical buyers. It was being set by paper markets. This brings us to the most important part of this story, physical silver itself. Physical silver is the enemy of manipulation. When you hold silver in your hand, it's outside the system. No counterparty risk, no paper promise, just metal. The more people move from paper silver to physical silver, the weaker the control becomes. That's why delivery is discouraged. That's why cash settlement is preferred. That's why most futures contracts never end in delivery. Only a tiny percentage of COMEX contracts actually result in physical silver changing hands. The rest are rolled over or settled in cash. This keeps the illusion alive. As long as people don't ask for metal, the system survives. But cracks are forming. Registered silver inventories on COMEX have been declining over time. That means less silver is available for delivery. At the same time, industrial demand keeps rising. Green energy needs silver, electric vehicles need silver, military tech needs silver. This is not slowing down. So who actually controls the silver market right now? In the short term, it's the paper traders, the bullion banks, the institutions with the power to move prices using leverage. But in the long term, control always shifts back to physical reality. Paper can control price. Physical controls truth. The silver market is a battle between illusion and reality, between contracts and metal, between leverage and scarcity. And we are slowly approaching a point where both cannot coexist peacefully. If too many investors demand delivery at the same time, the system faces a serious problem. There simply isn't enough silver to go around. And when that moment arrives, price discovery will be forced back into the physical market. This is why understanding COMEX and LBMA is so important. Not because they are evil by default, but because they show how modern markets work. They prioritize liquidity, leverage, and speed. Not honesty, not scarcity, not long-term value. Empire economics exists to help you see behind these systems, to understand not just what the price is, but why it is what it is. And this story is far from over. Because in the next part, we're going to talk about what happens when the system finally breaks down, what a real silver squeeze looks like, why governments and central banks care deeply about silver prices, and what role everyday investors might play in the biggest precious metals shift in modern history. Before we continue, drop a quick comment below. Do you think silver prices are manipulated, or do you think this is just how free markets work? Your comments help this video reach more people, and I read every single one. If you're finding value here, share this video with someone who's interested in real economics, not surface-level headlines. And stay tuned, because part 2 is where things get really interesting. Now let's talk about what happens when pressure builds inside a system like this. Because no paper-based market can survive forever when it's disconnected from physical reality. History proves this again and again, and silver might be closer to that breaking point than most people realize. Every major financial crisis exposes weaknesses that were hidden during calm periods. In the silver market, those weaknesses show up when demand for real metal rises faster than supply, when investors stop trusting promises and start asking for delivery. This is where the idea of a silver squeeze comes in. A real silver squeeze is not about hype or social media trends. It's about math. Simple math. Limited supply versus growing demand. Mining new silver is slow, expensive, and energy intensive. You can't just double production overnight. On top of that, most silver is mined as a byproduct of other metals like copper, zinc, and lead. That means even if silver prices rise, miners can't instantly increase output. At the same time, industrial demand keeps climbing. Solar energy is one of the biggest drivers. Every solar panel uses silver. As countries push toward green energy, silver demand rises with it. Electric vehicles need silver. 5G technology needs silver. Medical equipment needs silver. None of this demand is optional. It's structural. Now combine that with investment demand. When inflation rises, currencies weaken, and trust in financial systems declines, people naturally look for hard assets. Gold gets the headlines, but silver attracts everyday investors because it's more affordable. That's when physical silver disappears first. This is where COMEX and LBMA face their biggest risk, not price volatility, but loss of confidence. Because these markets rely on trust. Trust that paper claims can be converted into metal if needed. Trust that inventories are sufficient. Trust that the system is fair. Once that trust is broken, everything changes. We've already seen warning signs. Delays in delivery, rising premiums on coins and bars, dealers charging far above spot price. That premium is the real price signal. It tells you physical silver is scarcer than paper markets admit. Governments and central banks understand this very well. That's why silver is treated differently from gold. Gold is openly held by central banks. Silver is not. If silver prices were allowed to reflect true scarcity, it would expose inflation, currency weakness, and systemic risk across the financial world. Silver has always been a monetary metal for the people. Throughout history, when currencies fail, silver circulates again. That's not a coincidence. That's exactly why controlling its price matters. Paper markets help maintain confidence in fiat systems. A rapidly rising silver price sends a dangerous message. It tells people something is wrong. It tells them money is losing value. It encourages them to exit paper assets. This is why price suppression, whether intentional or structural, always benefits the system in power. But here's the twist. Physical reality always wins eventually. At some point, industrial users will compete with investors for limited supply. Governments may step in. Export restrictions could appear. Strategic stockpiles might be formed. When that happens, paper silver becomes irrelevant. Price discovery moves back to the physical market. And when that shift happens, it doesn't happen smoothly. It happens fast. Silver is a small market compared to stocks or bonds. It doesn't take trillions of dollars to move it. A relatively small flow of capital can cause massive price moves. That's why silver is so volatile. And that's why it's so dangerous for leveraged systems. If just a fraction of paper silver holders demand delivery, inventories drain rapidly. Once registered, silver runs low, exchanges face a choice. Allow prices to rise sharply or force cash settlement. Either option destroys confidence. Cash settlement tells the world there wasn't enough silver. Rising prices expose years of artificial suppression. There is no painless exit. This brings us to the role of everyday investors. Contrary to popular belief, retail investors are not powerless. They don't control paper markets, but they do control physical demand. Every ounce removed from circulation tightens supply. Holding physical silver is not about getting rich overnight. It's about removing metal from a system built on leverage. It's about opting out. Empire economics doesn't tell people what to buy or sell, but it encourages understanding. Because once you understand how COMEX and LBMA work, you realize the silver price you see is more of a suggestion than a truth. The real price is what people are willing to pay when silver is scarce, and scarcity is growing. As debt levels explode, currencies weaken, and geopolitical tensions rise, hard assets regain importance. Silver sits quietly at the center of all of this, ignored by mainstream media, misunderstood by most investors, but essential to the modern world. The question is not if the silver market will change. The question is when. And when it does, those who took the time to understand the system will not be surprised. They'll already know why it happened. So let me ask you this. If paper silver truly represented physical supply, why is delivery discouraged? Why are premiums rising while spot prices lag? Why does silver crash in seconds but rise slowly over weeks? These are not random events. They are signals. If this video helped you see the silver market differently, make sure to leave a comment below with your thoughts. Do you believe the next major move in silver will be driven by physical demand? Or do you think paper markets will continue to dominate? Also, don't forget to share this video with someone who's interested in real economics, precious metals, or financial truth beyond headlines. Sharing helps Empire economics grow and reach people who are asking the same questions you are. And if you haven't already, subscribe to the channel so you don't miss future deep dives into markets, money, and power structures that shape our world. Because in a world built on paper promises, understanding real value is the ultimate advantage.